Good morning, and welcome to our latest LGFP seminar. So, first of all, I would like to begin by acknowledging our Wiri people of Wangang and Jangalingu country. They're the traditional owners of the land on which I am today, and I offer my respects to their elders past, present, and emerging. And I also extend that acknowledgement to the traditional owners of the land wherever you may be joining us from today. So, welcome to our latest webinar from the Local Government Finance Professionals of Queensland. We represent finance and accounting professionals in Queensland local government and have done for 45 years. What do? We produce amazing guidance papers like the one you hear today and fantastic professional development opportunities for our members. If you're not an LGFP member and would like to join, see the membership area on our website or email admin@lgfp.org.au. It's a tax deductible $75, the best value around. So today's webinar is based on LGFP's Accounting for Infrastructure Damaged by Significant Weather Events guidance paper. That's a mouthful. We'll walk through the decision-making framework covering asset disposals, impairments, revaluation impacts, with a spotlight on materiality thresholds, disclosure requirements, oh, that's a tongue twister, and more. The session will equip you with the tools to make defensible, well-documented accounting decisions in the wake of disaster. ChatGPT comes up with some great descriptions for our webinars. So today's presenters are Brodie Saw from Local Government Finance Professionals. So Brodie joined LGFP committee in November 23 as an observer before being elected as a committee member in November 24. Brodie has been Corporate Asset Policy Manager at Brisbane City Council for the past 3 years after spending 7 years with the Queensland Audit Office, auditing local governments. So he came over to the better side from after being in audit. In his current role, his primary focus is developing asset-related policy and performing an analysis and review of useful lives and revaluations. So members who attended our conference last year may also remember Brodie for his awesome dance-off skills. So we also have Sri from the Queensland Audit Office, and Sri has over 20 years experience providing audit and assurance services for both the public and private sector. And he is no stranger to our LGFP family. He's worked in 5 different countries across a number of sectors and found his happy place when he started with the local government sector 6 years ago. Oh, local government's your happy place. Sri is a Senior Director with the Queensland Audit Office and leads the local government sector. During this time, Sri has gained experience working with councils in every segment, small and large, and understands the unique challenges faced by council. Sri has also presented a number of topics on our webinars and at our conference and forum before, as well as with IPWQ and the Department of Local Government. So we'll have plenty of opportunity for Q&A. So to submit the questions, please use the live Q&A button on your screen. Feel free to submit them throughout the webinar to be responded during the Q&A. And the presentation will be available after the webinar through the members library on our website. So take it away, Brodie and Sri.
Cheers, Zoe. So we'll just get stuck in today. So given the recent events across various parts of the states with cyclones and flooding, we felt it timely to dust off the guidance paper on accounting for infrastructure damaged by significant weather events that we published back in 2022, I believe. This time, though, instead of 10 pages of pure accounting technical speak, we thought a webinar might be a nice way to maybe make the topic a touch more palatable for you all. But before we jump into any specifics, though, always best to put a disclaimer on this webinar. This is obviously going to cover general advice, and of course, we're going to try and dive into some examples as part of that. My hope is that those examples, although likely fairly generic and simple, where applicable, the theory and logic behind them is something you'll be able to apply to your own situations where relevant. Ultimately, though, the content and examples in the webinar are just that, examples. So the best way to make sure you're approaching this in the right way is to engage with your auditors. Having spent almost 7 years with the QAO, and Shree's got me well covered there, I can't stress enough how happy it made me when a client would call to discuss an issue they have, particularly one of the potential magnitude, like accounting for infrastructure damage from a significant weather event. And really, it's just going to put you in the best position to get the right outcome in the first instance. So now that the disclaimer is out of the way, let's get stuck in. First of all, the most important concept that needs to underpin everything you consider in this space is materiality. In saying that, the applicable materiality threshold is going to vary depending on whether we're talking about repairs and maintenance, additions, disposals, or impairment through the statement of comprehensive income, which are likely to be assessed against your overall materiality threshold that's set as a percentage of your total expenditure, as opposed to your revaluation decrements through equity, which are likely to be assessed against a much higher PPE, property, plant, and equipment specific materiality threshold. Small note on that, if you are in the rare instance where a revaluation decrement would normally go against a reserve and equity, but the reserve will go past a nil balance and therefore require some of the revaluation decrement to hit the statement of comprehensive income directly, then in that instance, this would be assessed against that smaller overall materiality threshold. For the purposes of this webinar, we're going to think of how you're going to approach accounting for infrastructure damage by significant weather events as one big decision tree, which I'll bring up here now, and we'll bring to the main screen. I think it's there now. I appreciate at 60% zoom, this probably looks horribly unwieldy and complicated, and that's why this wasn't the way we ended up presenting the information for the guidance paper. However, that's one of the benefits of the webinar. We'll be able to zoom in and go step by step over each possibility. The first and most important question, as I do zoom in, hopefully that's big enough for everybody. The first and most important question is to assess if the impact to the condition, service capacity, or utility of the assets in question is still present at 30 June of the relevant reporting period. Obviously, the closer to 30 June the event occurs, the more assets are likely to have that effect still present and go to the right or the yes side of this decision tree. But I'm going to hand over here now to Shree, who's going to run through the left or the no side of that decision tree.
Thank you, Brody, and good morning, everyone. Thanks, Zoe, Carly, and the LGFP for allowing me to force myself into this webinar, which was a couple of weeks ago. Look, as Brody said, this decision tree, when I had a look at it last week, I felt that this is probably the easiest way to show how you account for a damage to your assets arising from natural disasters, right? As Brody said, the paper came out 3 years ago. We are living in a state that's not immune to natural, which is immune to natural events. We constantly get weather events in some form or the other every year in every part of the state, most part of the state at least, right? So when I looked at the decision tree, I thought this is very well put, very simply put. Again, as Brody said, it comes with a bit of a caveat. These are best known possible scenarios. There could be a very unique situation that a council might have, and if you do have one of those, come and talk to someone at the QAO, or if you're contracted auditors, reach out to them in the first protocol. Okay, so the way the decision tree is set up, as Brody said, we're looking at whether there's going to be an impact on the condition, service capacity, and the utility of your assets at 30 June, and we've tried to, I should say, Brody is trying to break this down into two possible scenarios, a yes and a no. So I'll cover up all the no possibilities, and then I'll hand it over to Brody, who'll cover up the yes, and then we'll start taking questions together. Okay, so if the answer to your question is no, there's multiple scenarios that is possible, right? So let's look at each one of them from a decision tree perspective. Brody, I just thinking, maybe do you want to zoom in a little bit more on the no side of things first, so that we could probably cover that off with a little bit more ease on the eye, and then we can shift to the right of the screen if you can. Yep, perfect. Right. So the first scenario we're looking at is your assets been disposed, right? It's not been replaced as yet at 30 June. So it's a simple accounting where you've gone, the assets either completely destroyed or to an extent that it can't be used anymore. So you've decided to dispose it off, as in write the asset off in your books. So you basically have to reverse the asset out. So in terms of the accounting entry, it's a simple one. You take the net value of your asset, which is the difference between your gross and the accumulated depreciation, and whatever is remaining, you write it off to your P&L as a loss on disposal. So that's probably the easiest of all of them. Then as we go along to the right, there's a little bit more complicated scenarios that come through. The second scenario is where we looked at a very similar situation where the asset's been disposed of, but it's been replaced at 30 June. Again, very similar to the previous example where you write the asset off, whatever value of the asset is remaining in your books at 30 June, you write it off for disposal. But now that you actually replaced the asset at 30 June, you recognize the asset as well in the book. So that'll be at the cost at which you've acquired the asset, or a value at which you've determined is right value to record the asset in your books. So that could be debit asset, credit cash, payables, whatever that is. Right? The third scenario is where the asset's been disposed of. So extending on from the first example, where the loss is recognized in the income statement. Now, this is an asset where you're starting to build and it's not completely ready as yet. So very similar to the second one, where you'll have to capitalize the cost of construction today. But because the asset has been fully built or constructed and has not been put to use and not been ready for use, which is the standard term that's used in the accounting standards, you can't capitalize the asset yet, but you still carry the cost in what you call as an asset in the construction or work in progress. So it's still having the same impact as the second scenario, but just that you're not putting it as a part of your gross value of the asset, but keeping it as a work in progress. The fourth one is a partial disposal. So let's take an example where you have an asset, say it's a 3-lane road, for example, and some of you might have heard me talk about this at the at the Tropical workshop not so long ago. Say you have a 3-lane road that is in your council area. A part of the lane has been damaged to the extent that it can't be repaired and used. It basically has to be disposed of, right? Now, that's where the partial disposal comes in the sense that the whole road is not damaged. It's only a part of the road. So what you try and do is that you try and determine the value of that part of the asset that has to be disposed of. Now, in some scenarios, it'd be quite easy, depending on the quality of the asset register, how you segmented the road, how you categorize the roads. It'll be easy to determine that. But where you don't have that level of sophisticated asset data, don't get too worried. Make a high-level estimation of what best you can come up with, and go, if 1/3 of my road has been disposed of, my road's worth $3 million, just say arbitrarily, I'm going to write off $1 million. So that's the logic you would ideally apply in a scenario like that. So again, so there's a partial disposal, so there's still a value to be recognized through your income statement. So you recognize that value of the asset which is partially disposed of as a loss on disposal, and the replacement component basically gets recorded as an asset. Or if it's still under construction, you record it as a work in progress. And the last one is where the damage is not so big that it doesn't impact your assets' useful life. It doesn't impact your condition to the extent that you would need a significant replacement, which is a simple repair. So there's some of these councils that I'm currently working with, they've had small repairs that needs to be undertaken. The road's still usable. Let's say you have a road where your normal speed limit is, say, 60 kilometers an hour. Because of some of those potholes and things like that, you can't use it at 6 kilometers an hour. You can only use it at 40 kilometers an hour. It's still a usable road. It's just that the usability is slightly reduced, but not to the extent that an asset can't be used at all. So in that scenario, you'll just treat it as a simple repairs and maintenance, where you'll go debit your repairs and maintenance expense, credit cash payable, which means that it'll have no impact on the asset side or the balance sheet side at all. I'll run through those 5 examples very, very quickly. Should we just hold and see if there's any questions that someone might have?
Nope. I think we're good for now.
Okay.
Cool. I will jump up then. So we're going to jump back up to that first overall question. But this time the answer to whether there's been damage from the weather event is still impacting the condition, service capacity, or utility asset at 30 June is yes. So I'm going to keep moving over. Before we work our way down the decision tree, I'm just going to cover off on this dotted line here a possible scenario. This is probably going to be most likely where the weather event occurred very close to 30 June, leaving minimal time for condition assessments. This is where you're unable to perform complete and reliable condition assessments as at 30 June for your council's affected assets. There is never going to be a one-size-fits-all answer for this, so the best place to start in this situation is talking to your auditors. That's probably going to be a good starting place in most of these scenarios, as we've already touched on, but especially if this is a situation you find yourself in. Now, I'm just going to jump back here and might zoom out just a touch. One more. There we go. Now, the key difference when determining the appropriate accounting treatment for assets with the impact still present at 30 June, as opposed to those that don't, that Shree's already covered off on, is the most important consideration is actually the valuation method of the affected assets. And I'm actually going to start with the least common valuation method you'll find in local government, being the income approach. These are income producing assets that are likely going to be valued using a discounted cash flow. Here you're going to look to update those inputs to the discounted cash flow, namely the future cash flows, revenues, expenses, and the like, along with your discount rates and cost escalations built into the model. How any reduction in fair value as a result of the updated inputs to the discounted cash flow model are recorded will depend on the size of the reduction in fair value and any revaluation reserve associated with that asset. Where a sufficient equity or reserve balance exists on the left here, the debit can be recorded to that reserve balance. Where the balance exists but is insufficient, the middle example here, the balance or the remaining reduction in fair value after the reserve is brought to nil is recorded as an expense to the statement of comprehensive income. And the final example here on the right is obviously if no equity or reserve exists, the entire reduction will be recorded to the statement of comprehensive income. What we're going to do now is move on to the market approach. Move up just slightly. The most common types of assets that are valued using the market approach are land, plus there's probably some buildings out there too. The type of asset and the nature of the damage or impact is likely going to lead to significant variances in accounting required in this particular part of the decision tree. Focusing initially on land, particularly a scenario where the parcel was flooded because of the weather event. Now, whether a parcel of land floods or not is going to have an impact on its valuation method under the market approach. However, the question is whether the susceptibility to flooding was known and accounted for in the pre-event valuation of the asset. Where it was, you're likely going to end up on the left here, not being required to record any change in fair value because of the event. On the other hand, the right scenario here, the level of flooding may have been unprecedented and affected a parcel of land previously not considered at risk of flooding. In this instance, how you account for the impact of flooding of parcels of land more broadly is going to drive how you determine the impact on specifically newly impacted parcels. If the value is judgment is the primary method used to determine the appropriate level of fair value impact from properties impacted by flood risk, then you're likely going to need to work closely with the valuers to determine the level of impact. I've also seen some instances where valuers determine an unaffected by flood valuation for a parcel and then apply consistent level of discounting depending on the level of flood impact. So no discount where there's no flood impacting. A small portion of the lot might be impacted, so a small discount's applied. And then if a large portion or the entire lot is impacted by flooding, a larger discount is applied, for example. In this scenario, based on updated flood zoning post-weather event, the council might be able to apply those same discounts to the newly affected parcels to determine the level of impact without much or any assistance from the valuers. For a building still under the market approach, again, whether the type of impact, like flooding, was already accounted for in the valuation will determine whether an update to fair value is required. There are, however, a broader range of types of damage or impact on a building compared to land, though. A roof may require replacement, and the associated water damage internal to the building might result in the need to replace flooring and remove mold, for example. At 30 June, there might be an estimate to rectify that damage totaling $200,000. This estimate is a solid foundation for a revaluation decrement to the asset to account for the reduction in condition at 30 June. When incurred in a future period, those costs and the asset can be accounted for in accordance with the first set of examples that Shri covered at the start of this webinar. Now we're going to cover the most common valuation type in the local government sector, the cost approach, or more commonly known as current replacement cost. Scrolling down here, and I'm going to have to zoom out again, sorry. One more time, two more times. There we go. Scroll down. So here there are two major ways the impact of the event can affect the asset. The first is through loss of useful life. How you determine and quantify this loss of useful life is going to differ greatly depending on the type of asset in question. You will note, though, that the debit and credit at play here is the same. It is just simply how you approach calculating and determining the impact that differs. So where there is on the left here, a singular specific asset, say a building, this process should hopefully be much simpler as you can engage with your asset management experts. The building may have had a remaining useful life of 10 years before the weather event, and now the asset management experts think the building will need to be replaced in 5 years. Simply reducing the remaining useful life from 10 down to 5 years, and then updating the net book value of the asset to reflect this via a credit to the accumulated depreciation and a debit to the asset revaluation reserve, assuming a sufficient balance, would be appropriate. On the other hand, on the right here, the affected asset, or more specifically assets, might be a much broader, to the point of being a significant subset of your entire council's network of a specific asset. Major flooding, for example, may have resulted in significant portions of a road network being affected across numerous suburbs. Comparison of pre and post event condition surveys, if available, will aid in determining the quantum of effect on groups of assets. However, depending on how these assets are grouped in the financial asset register, these effects may need to be extrapolated over the relevant network to determine an estimate of the total dollar impact. An example of what I mean here is some councils capitalize assets like road surface, for example, by year. So say 20 roads were resurfaced in a financial year. These costs are grouped and capitalized as a singular asset. Of these 20 roads, 5 of them in our event example here may have been in the flood affected areas, but because they're all going to the different lengths, they'll all be different lengths of asset, and by extension, their value will differ. It isn't as simple as saying the impact is to 25% of them, 5 of the 20. More likely, your asset management experts will look at the impact and, for instance, say the affected area comprises 20% of the network, and the assets affected within that 20% of the network have lost, say, 5% of their useful life. Applying that effect to individual assets in the fixed asset register when they are grouped by capitalization year, for example, is going to be near on impossible. In a scenario like this, where it's been calculated via extrapolation to a whole of network level, it's important. You're likely going to record the effect via a general ledger journal rather than to specific assets. So that's the clear difference between these two boxes here. It's important to remember before considering recording the effect of this, how reliable the estimate is and whether the impact is material should play a big part in what you do here. The second way an asset can be impacted from a major weather event over on the right here is through the impact of level of service provided. This can be partial, say I'm going to go a 4-lane road, not a 3-lane road, and it only has 2 lanes open due to the effects of the event. Or it could be a complete loss of service, say a bridge that's been damaged and requires works before it can be reopened. Either way, an estimate of the cost to restore the asset to the pre-event level of service can be used as the basis for the revaluation decrement to be posted. Bear in mind, the decrement should not result in the asset's value dropping to nil. So say the minimum post-decrement value might be $1, for example. The 3 ways the revaluation decrement can be recorded mirror that of the income approach that we've already covered. In that, on the left here, the decrement can be recorded entirely against the revaluation reserve account where there is a sufficient balance, entirely through the statement of comprehensive income on the right here where there is no revaluation reserve balance, or in the middle here, a combination of the two, where some balance exists in the reserve, but it is insufficient. Finally, I'm going to move up to those assets not recorded at fair value, but rather historical cost. Zoom in a bit for you all. For almost every single council, that is going to be your plant and equipment. And for plenty of councils, they also have some minor classes of infrastructure that this is applicable to as well. Just as with those we just covered under the current replacement cost grouping, the type of impact can be split into both a reduction in useful life or a reduction in the level of service. The manner of assessing and method of recognizing is also very similar. For a reduction in useful life, say a truck that's still operational, but you'll replace it after 1 year rather than 4. You'd be updating the remaining useful life from 4 to 1 prospectively and recording an update to the net book value through your accum account. However, the other side to the entry, unlike with current replacement cost, can't be equity because this asset isn't held at fair value. So instead, should be via impairment expense through the statement of comprehensive income. The same logic applies with the level of service, loss of service level, sorry. That concept of using the estimate of rectification works should still apply, but again, the opposing entry would be impairment expense through the statement of comprehensive income rather than a revaluation decrement through equity. Before we go on to any further sections around financial statements and the like, I'm going to pause there and check if we have any questions that have come through or if Sri wants to add anything. Looks like everybody's just enjoying what we're talking about. So I'm going to jump on then to financial statement implications of all of this work. So the time and effort it will take to assess and document all of these considerations after a significant weather event is going to be substantial. So this should be accounted for in working through your year-end timetables around financial statement preparation. Additionally, consideration should be given to the inclusion of disclosures relevant to significant weather events to ensure meaningful information is provided to your users. These financial statement impacts can go beyond the points that we've covered in this decision tree. Things like additional leave days provided to staff during the event. And any new or additional disclosures in this space should be presented to your audit committee, where you have one, for review as early as possible. Sri, did you have anything else on the fin stats? And if you do, I can't hear. Oh, there you are. Yep.
Right. I had myself muted. I just want to reiterate that some of the disclosures can be quite complex. So, regarding what scenario the different boxes we talked about you are sitting in, just make sure that if you're not 100% sure, come and speak to your auditor so we can actually help you guide and get those disclosures appropriately done. A couple of years ago, I can't remember which council it was, that they've done everything right, the accounting side of things, but their disclosure went wrong and it resulted in a restatement in the next year. So, especially as you're getting closer and closer to 30 in October, there's a lot of pressure to get things done, get it over the line. So just give yourself enough time and discuss with your auditors as early as possible when you can.
Awesome. And I guess beyond the LGFP guidance paper that was issued 3 years ago that we've already talked about, the QAO have recently updated their blog, Shri, I believe, on assessing the impacts of natural disasters on your financial statements. And Queensland Treasury also has a self-assessment checklist for identifying, accounting and reporting the impacts from natural disasters. But Shri, I think you said you were going to collate, there's something being collated?
Correct. Yes. So what we're doing is we're trying to put together a package of almost like it's just a one-pager, just acknowledging the challenge that this is bringing about to council, both from an operating and accounting perspective. And what we're planning to do, Brody, is that we will, in a one-pager, will summarize all the available materials to councils when it comes to accounting for natural disasters and what they need to consider. So there's about 3 or 4 blogs that we've done in the last couple of years. Understand a lot of the people in the sector might be new or have forgotten where these things are. So this will include the link to all our blogs, and I'll check in with the LGFP in terms of whether we can add the links to their paper as well, given that it's a member-only service.
Yep. Too easy. Zoe, I'm going to check again. Have we got any questions, or it was all really clearly explained? Looks like. Oh, we do have a question.
Yep. Yeah, just come through. I'm just reading it. The short answer is yes, it will have an impact in asset management plan and strategies, largely because if you have a group of assets that you had, say, originally planned in your asset management plan to be replaced in 30 years, but because of the damage that has happened to your asset, and if it needs a full replacement, say originally this asset was a 50-year-old asset that you had originally procured at the time, and that's how you had planned to use and depreciate this asset. Now 5 years in, this is not going to be worth that many more years. That means that you'll have to be reflecting that in your asset management plan and strategy, so that you're effectively starting over from the point of time when you start replacing the assets.
Okay, so Shri just answered a question, but for everyone who wasn't aware, the question was, will there be any further guidance around this matter, and in particular, whether any requirement to reflect this in council's asset management strategies or asset management plans? So that was the question that you just answered, wasn't it, Shri?
Sorry, yes, I did. Sorry, I didn't realize that the question was not visible to the others.
That's okay. We've got another couple of questions that have come through if you want to answer those. So what have we got here? With regards to the subset of network assets, if you record a GL journal instead of to specific assets, would there be any difference between the fixed asset register, that you mean the sub ledger, and the general ledger? So would this be a permanent reconciling difference? How would you handle it?
It would be at 30 June because obviously you've posted it to the GL and not to the FAR, but the intention there is just to ensure that the effects in terms of a dollar impact are being recorded in your financial statements. My expectation would be that once you get to 1 July, or you roll your ledger per se, you'd reverse out that general ledger journal, and then over the course of the next 12 months, the various appropriate accounting treatments that Shri covered on the left-hand side around the no, where you're doing partial disposals, repairs and maintenance, whatever the appropriate accounting treatment would be, you would record that against the specific assets once it becomes clear what specific assets are being impacted and what work you're doing on those specific assets. Now, you might still end up in a position where in 12 months' time, the following 30 June, there's still a few assets out there that you still haven't got around to renewing them or rectifying them, and then you'd be going through that process again of saying, what portion of the network. Hopefully after 12 months, that portion is a lot lower and you then can get into that specific asset side where it is just a very finite number of assets and you can do it more directly into the fixed asset register rather than a GL journal. Shri, unless you had any other thoughts on that one?
Spot on, sir. Spot on, Brody.
Okay. Well, we don't appear to have any more questions coming through, but what a fantastic technical session. Thank you so much. So the guidance paper and the decision tree will be circulated to attendees in the coming days, and
We have
will
another
also
one,
be
Zoe.
available. Oh, we do.
Yep.
Okay. Well, we did have a question about the guidance paper, so it is available in our members library now, but we will circulate it, and a webinar recording will be there, available on our YouTube channel. So we have another question. Okay, so further to the asset management plan query, how do we intend to align our accounting practices with resilience and adaptation planning? Good one. Shri, maybe that one's yours.
For the hard questions for the auditors, eh?
Yeah, of course.
Look, this is always going to be a tough one. Can I say off record that sometimes accounting and common sense don't match, right? Off the record. The thing is that, right? I mean, it's a perfectly valid question. We live in a state where we constantly get hammered by weather events. We constantly have damage to our asset. If we come up with an asset management plan that's going to constantly change year after year, how do you keep on top of that? No simple answer to that. There's no silver bullet to these sort of things. Unfortunately, there's a requirement for us to maintain the asset management plan. There will always be a bit of a misalignment, but remember that your accounting is a year-on-year thing. Your asset management plan. So if there's a mismatch at some point in time, hopefully there'll be at some point in time in the future you'll be able to align them together. As I said, it's a good question. It's a tough answer to give. There's no simple answer to this thing.
Well, thanks, Shri. And I mean, it's true. This is, I guess, we live in Queensland. This accounting for the damage from disasters and natural events, it is a fact of life for eventually for all of our councils. So, we have another one. Shri, in your opinion, they're picking you, Shri. In your opinion, are our financial statements adequately disclosing the impacts of significant weather events?
I can't see the questions. Oh, yeah, I don't think it's been popped in the chat. Can you repeat that again? Sorry.
Yep. So, in your opinion, are our financial statements adequately disclosing the impacts of significant weather events?
Right. So I read this question in two ways. So one is the actual impact. When you talk about the impacts of significant weather events, I'm talking about how it has impacted the assets and stuff. So if you're talking about the quantitative side of things, it's just what we talked about for the last maybe 30 odd minutes in terms of how you do your accounting and disclosures. I would say mostly yes. I would say largely yes. Now, the other side to this is impact of significant weather events could be treated as your climate risk. Now, thankfully, at this point in time, there's no requirement for councils to disclose any of this in the financial statements. Although the standards are out, it's not mandatory for the sector yet. Some councils are slowly thinking about how they can start putting more stuff in their annual report. This is more for their users for the community to try and understand how they're combating and what mitigating strategies and measures they're putting in place for their communities to address climate risk. Again, as I said, at this point in time, there's not much in terms of the qualitative side of things that councils need to put in the financial statements yet. We are working with the department to try and understand what their take on this is. I can tell you as of this morning, the standards haven't been made mandatory for the sector yet. We are, to an extent, reliant on Queensland Treasury to take the first step, I would say, in terms of what they're doing in the state sector. QAO have got a working group that is actually coming together in terms of assessing climate-related disclosure for some of our clients, like some of our Energy clients and those that are under the Corporations Act, some of them are classified as a tier 1 client, for whom the disclosures will start effective this year or next year, if I'm correct. So we are currently working with them. There's going to be a bit of a learning for all of us here. And our plan is at some point in time, by the time this gets implemented in local government, if it does, we'll probably have enough learnings to share with the sector to try and help them come up with the disclosures. To answer that question from another jurisdiction's point of view, if you take New Zealand, for example, they have actually mandated this only for 2 councils. I think it's Auckland and Wellington, their local government department equivalent, largely because they're larger councils. And in 2024 financial statements of both those councils, there were some disclosures that were made, which wasn't compliant to the new sustainability standards that will cover some of these things off.
Okay. Well, we don't appear to have any further questions coming through. So, look, thank you everyone out there in webinar world for your attendance. And as I said, you can access the guidance paper right now from our members portal. We'll be uploading the decision tree, but we will also circulate both the guidance paper and the decision tree in coming days to people who registered for the webinar. And a copy of the webinar will be available on our YouTube channel. So just a reminder that our next face-to-face professional development event is our annual Local Government Finance Professionals Forum, which is on Friday the 25th of July at the Brisbane Airport Centre, and it's free for members. So if you head to our website and go to our events area, there's all the information about registration. So hope to see you there in person at our forum in July. And thank you very much. And thank you, Brodie and Sri.
Cheers.
Thank you, Zoe. Thanks, Brodie.